हेलो स्टूडेंट्स, अस्सलाम वालेकुम। सबसे पहले तो I want to congratulate all those students of A levels with AS and A2 who have secured excellent grades. Congratulations. And all those students of AS and A2 who couldn't take good grades. So don't worry, work hard next time, inshallah. Sometimes we can't get good grades sometimes. It doesn't make any difference. Inshallah, you can do better next time. Inshallah, very dua aapke saath. And O-level students, I'm praying for your result. Inshallah, I think it's going to be announced on 18th of August. Inshallah, that will be Thursday, coming Thursday. Inshallah. So today we are going to solve AS accounts paper 1. So let's see your paper. Here is your paper. Line 706, May June 2022, paper 12. Okay. See, first accounting, first MCQ. Okay. Which accounting concept states that revenue can only be recognized after it has been earned? Okay. Now, before that, I should click for the tools. Okay. So that would be easy for me to write. Okay. Now, consistency, going concern, money measurement has nothing to do with the revenue recognized concept, only realization. D option is the answer. Getting my point clear? Okay. D option is the answer. Okay. A sole trader has changed the method of depreciation. Depreciating his machinery from the reducing balance method in the year 1 to the straight line method in the year 2 of trading. The same percentage rate of depreciation is used in both cases. Now, what happens in diminishing balance method? The second year's depreciation is lower than first year's depreciation. But if you switch to straight line method in year 2, it means the year 1 depreciation and year 2 depreciation is same. So if you switch it, what will happen? Your depreciation expense in year 1 and year 2 would be same. In year 2, depreciation expense was supposed to be lower using diminishing balance method, and your profit was supposed to be higher. But what happened? The next year, okay, you use straight line method. Depreciation expense remains same as year 1. So your profit for the year is lower. And yes, when your depreciation is the same of year 1 and year 2, your net book value will also be lower. So D option should be the answer. Okay. Paul has a year end of 31st December. On 1st January 2020, he bought a non-current asset for 10,000. He sold it on 1st January 2021 for $8,500. Paul usually provides depreciation at the rate of 10% per annum. A full year's depreciation is charged in the year of acquisition and none in the year of disposal. He forgot to provide for any depreciation on this non-current asset. What was the effect of this error on Paul's profit for the year ended 31st December 2021? Now in 2021, when he's selling the machine, he's not going to charge depreciation. So the book value at in year 2021, suppose if he had taken the depreciation, if he had taken the depreciation, the book value would have been 9,000, and the loss would be only 500. But because that 1,000 depreciation was forgot, so it means this year profit is going to be decreased by 1,000 more. That was supposed to be the depreciation of 2020. Now this will be charged as a loss in 2021. So the profit is lowered by 1,000. Why? Because it was supposed to be lowered by 500 only in 2021, just because we are selling, we are not calculating depreciation. But because we forgot to take the depreciation in year one, so it means the loss this time would be 1500. So this year's profit 2021 is lowered by 1000. Okay. Now a business depreciates machinery at 10% per annum using the straight line method on a month-to-month basis. The business financial year end on 30th June. Machinery which had cost 6,600 on 1st April 2020 was sold on 30th November 2021. The profit on sale was 350. Now the machine was purchased on 1st April and we are selling it on November 2021. That means April, May, June, July, August, September, October, November 2020, 1 year, and then 2021 second year. So 8 months in year one and 12 months in year two, it means total 20 months. So what we do, 6,600 multiplied by 10%. That means 660 per annum divided by 12. 1 month depreciation is 55 multiplied by 20. Total depreciation for 20 months is 1100. So in that case, what will happen? Okay, see, the cost is 6,600 minus 1100 depreciation, 5,500 plus 350 profit. It means he has got $5,850 for this machine. Okay. Now 5. Why does a business maintain sales and purchase ledger control account as part of double entry accounting system? Okay. Now it allows a trial balance to be prepared easily from the nominal ledger. Yes. It can involve separate employees, make fraud more difficult. Yes. There is no need to keep. No. There is no need to keep sales and purchase journal. No. It's not the use of purchase ledger and sales ledger control account. There is no need to reconcile. No. We need to reconcile control accounts with the personal account of suppliers and customers. So it means answer would be, the correct options are 1 and 2, and the answer is option A. Got it? Now, Dog received his business bank statement. He updated a cash book and prepared the bank reconciliation system. Which item appear on the bank reconciliation system? Bank charges are appeared on cash balances per cash book. Customer payment by direct debits, they are recorded in updated cash book. They are going to appear. Now, uncredited deposits. This is already recorded in the cash book, or it's not going to be included in the updated cash book. It's going to be recorded in bank reconciliation statement. So the answer would be A option. Okay. 31st December 2021, the sale ledger control account had a balance of 19,100, while the total balance sale ledger was 20,900. The following reconciliation had been prepared after the errors were located. Balance of sale ledger control account 19,100, credit sales omitted from the sales journal 1,600, discount on understated in sale ledger 200. Total of balances in sale ledger 20,900. Now what we have to do? Either take these two to answer. Okay. Or take these two to answer. Okay. 19,100 plus 1,600 is 20,700. Okay. 20,900 minus 200, 20,700. So D option should be the answer. Okay. Take either of one, so you can get the answer. Okay. Now, question number 8. At the year end, Victor had 100 units of inventory which had cost $12 per unit. Of these, 8 units had been received on the last day of the year and not been paid for. Okay. Now, according to International Accounting Standard, when you receive inventory, it's going to be part of your inventory, whether you have paid or not. Okay. You have to, the units become part of your inventory when you receive them, whether you have paid or not. Okay, now, so we are not going to discuss about these 8 units. Getting my point clear? Sorry, we are not going to discuss. Getting my point clear? Okay. Now, this 6 units, the 6 units, the problem was to this one, $20. Now, these 6 units are going to be sold for $10. So 6 multiplied by 2, $12. The loss, 6 units multiplied by $2, 6 multiplied by 2, $12, and $20 were additional expenses. So total $32 we have to suffer. It means our inventory value 100 units multiplied by 12, that would 100 multiplied by 12 is 1200 minus $32. So 1168, C option is the answer. Getting my point clear? Okay, now come to question number 9. Which items are treated as expense in the income statement? Now, no, this one. Okay. Accrued wages, yes. Prepaid telephone expenses, no. Increase in provision for doubtful debt, yes. So C option should be the answer. Okay. Now, question number 10. At 31st December 2021, the draft statement of financial position for a business show total assets 1 million. Now, following errors were discovered. Increase in provision for doubtful debts 5,000 had not been recorded. Okay, so 1 million minus 5,000 minus 20,000 closing inventory overvalued. Okay, minus 10,000 depreciation not recorded, 965,000. Sorry. So A option should be the answer. Very simple. Okay. Now, on what basis does a trading business produce an income statement? Cash received and paid out by the business in the year, income earned less cost incurred by the business during the year, revenue received less any cash paid out by the business during the year. I must tell you one thing. Okay, we do not make income statement on the basis of cash received or revenue received. On the basis of income earned. Getting my point? So D option should be the answer. We record on the basis of earnings, not receiving. Okay, 12. Now, a business provides the following information. Okay, revenue, opening inventory, closing inventory, purchases. Okay, goods are sold at cost plus 25%. So it means markup is 25%. When 25% is markup, 20% is margin. This is a trick. Don't forget. Okay, but only for when markup is 25%. Okay. Okay. The owner has taken goods for own use but has not recorded these as drawings. What is the value of goods taken for own use? So what we do, revenue is 1,40,000 multiplied by 20%. 28,000. Okay. It means 1,40,000 multiplied by 80% is cost. 112,000 is the amount of cost. Add closing inventory 24,500 minus opening inventory 22,000. 1,40,000 multiplied by 80%. 112,000 plus closing inventory 24,500 minus opening inventory 22,000. 114,000 minus 20,000 purchases, 5,500. Getting my point clear? 5,500. So that means A option is the answer. Okay. Now, a business owner does not maintain a full set of accounting records. At the end of the financial year, the following information is available. Okay. Now, trade payables, opening balance, closing balance, return outward payment to trade payables. So that would, okay, there were no cash purchases, no opening and closing inventory remained the same. Okay. What is the amount of cost of sales? So what we do, payment to trade payables, 110,600 plus returns 1,000. Okay. Plus closing balance 27,400. Minus 22,500. The answer would be 13. Okay. Answer would be yeah. Okay. 110,600 or 110,600. Okay, payment to trade payables. Plus closing balance 27,400. Okay. Minus opening balance 22,500. Answer is only 15,500. Now, question number 14. The partners provision of Partnership Act apply if partners do not draw partners agreement. Which statement is true as provision of Partnership Act? If partners do not have any partnership agreement written, interest on drawing is charged at 5%? No. Interest on loan from partners 8%? No. For partners are not entitled to receive salaries. This is correct. Okay, partners to be shared, profit to be shared in the ratio of fixed capital? No. No. So C answer, the option should be the answer. Okay, 15. Now, Dua and Noor are in partnership sharing profit and losses equally. They admitted Z and now share profit and losses in the ratio Dua, Noor and Z 2 to 1. On admission of Z, tangible assets were reduced in value by 20,000 and goodwill was valued at 60,000 but was not retained in the books of account. What was the net decrease on Noor's capital account? So what will happen? Now, first, before the admission, the goodwill is 60,000, so it means she will get a share of 30,000 of goodwill. Okay, and okay, she will get 30,000 credit in her capital account. Okay, now 20,000 loss means before admission of Z, they were sharing everything in equal. So 30,000 she will share goodwill as a credit and 20,000 as a debit for 10,000 as a debit for decrease in the value of tangible assets. So now in her account, there is a credit of 20,000 for goodwill and 10,000 is reduced because of the decrease in the value of tangible assets. Now, when after the admission of Z, they will remove goodwill from accounts. This 60,000 goodwill is going to be reduced from the accounts of all the partners in the ratio 2 to 1. So 2 to 1 means what much is the share? 60,000 multiplied by 2 divided by 5, 24,000. So it means Noor's total capital is decreased by 4,000. Okay. Now 16. The following information is available. Profit for the year before interest is 15,000. Okay. Minus interest on partners loan. Okay. 1,000. It means 14,000 is profit of the firm. That 14,000 is going to be apportioned between the partners. Simple answer. Okay. Which item should not be recorded in a statement of changes in equity? Profit from operations for the year. This is only retained profit is a part of it, not the profit from operations. Okay. Okay. The following information has been extracted from the statement of financial position of a limited liability company. Okay. Value of total equity. What items are included in total equity? Okay. See, ordinary share capital, how much? 400,000 plus share premium 50,000 plus retained earnings 75,000. 525,000. A option is the answer. Okay. 19. Okay. Question number 19. On 1st January, X Limited had share capital of 100,000 ordinary shares which have been issued at their par value of $1. There was no share premium account. On 1st March, a bonus issue of 1 new ordinary share for every 5 ordinary shares held was made from retained earning. Okay, bonus share. While issuing bonus shares, the double entry, to complete the double entry for bonus shares, what we debit, which debit share premium account, but we do not have share premium account here. Okay, now see what happened. On 1st June, the company made a right issue of one new ordinary share for every 4 ordinary shares held at a price of $1.5. All the rights were taken up. Okay. Now, in this case, what happened? See, first of all, the calculation. Now, ordinary share capital was 100,000 and bonus share was 1/5. One new ordinary share for 5. 1 upon 5 means 20%. So 100,000 multiplied by 20% means 20,000 more shares. Now, after bonus issue, the company has ordinary share of $120,000 per issue. When the company is issuing bonus shares and they don't have share premium, they compensate that from their profits from retained earnings. Okay. Now, after that, the company is making right issue. When the company is making right issue, at that time, the ordinary share capital was standing at 120,000 after the bonus issue. So one for every 4 means 25%. So 20,000 multiplied by 25%. 20,000 multiplied by 25% means more 30,000 shares. So when it is issuing, right issue would be made for 30,000 shares. 30,000 multiplied by 0.5 is the premium, so 15,000 should be the answer. Yes, premium account. Okay, 20. Okay. Now, the following information available for business: sales, purchases, gross margin, markup, inventory at the start of the period. Now, margin is 25%. It means cost of sales is 75%. Okay. 500,000 multiplied by 75% is 375,000 is the cost of sales. Cost of sales. Okay. Now, 375,000 is cost of sale. We have to calculate the value of closing inventory. Okay. Now, opening inventory 375. Opening inventory is 20,000 plus 365,000 purchases, 385,000. So it means the amount would be 385 minus 375. So would be 10,000. Yes. The following extracts were extracts from a statement of finance position of a company. Okay. Current, non-current assets, inventory, trade receivables, cash at bank, debit balance. Okay. Trade payables, bank loan, payable within 12 months. Okay. What is the liquidity asset test ratio? So we all know how to calculate current ratio. So what we do for liquidity ratio, we have to take liquid assets like trade receivable and cash at bank, no inventory, no non-current assets. Okay, and the liabilities, what we have to take is trade payables. Now what we have to do? So trade receivables 23,000 plus 12,000, 35,000 divided by the liabilities 15 and 40,000 means 55,000 divided by 55,000. The answer is 6.3 or A option. 0.63, 0.64. It's the nearest. Now 22. The cost of direct material is increasing. What is the effect if a business uses FIFO instead of FCO for inventory valuation in this situation? When the cost of direct material is increasing, it is better to use FCO. In Pakistan, what they practice because of inflation in Pakistan, most of the companies are using FCO. But why FIFO? They are using FIFO. Okay. So what will happen if they're using FIFO? FIFO shows, FIFO will give you less cost of sales. Okay, first in, first out. Because what happens, the inventory which comes later will have a higher price. So we don't include the inventory which is coming later. We only include which is coming earlier. So cost of sales is increasing, it means profit is increasing, and value of closing inventory is also increasing. So D option should be the answer. Okay. Okay, now 23. Q Limited employs machine operator and supervisor. Each machine operator produces 100 units per week. One supervisor can supervise up to 10 machine operators is paid $550 per week. Production is 7,700 units per week. Which type of cost is the supervisor pay and how much is their total pay per week? Achha. Now, type of cost, we have to tell about the supervisor's type of cost. Supervisor's salary is fixed for 10 machine operators, 550 per week. Okay. So 10 machine operators, that means it's a step fixed cost. Okay. I don't know the answer. So it means either A or B could be the answer. We don't know. They are not variable cost. We at least know that. Okay. Achha. Now total pay for their week is, production is 7,700 units. Okay. 7,000 each machine of 100 units. So means total would be. Now, what happened for now? See, 100 units and 10 machines means 100 units, one machine, and there are 10 machines operated. So it means 1,000. Are you getting my point? 1,000 is supervised by one supervisor. For 7,700, we need 8 supervisors. So 8 supervisors, when they are paid by $550, the answer would be 4,400. So it means B option is the correct answer. C or D is not a possible answer. Okay. Now question number 24. What is a limitation of absorption costing? Okay. It does not comply with accounting principles. It does not take into account all costs of production. No. It is not accepted for preparing published financial statement. No. It is not useful for improving the organization's performance. Yes. This is the limitation. Okay. It is not useful for improving organization. For improving the organization performance, we need marginal cost. Getting my point clear? Okay. Now see question number 25. Okay. Opening inventory, closing inventory is given. Absorption cost profit and marginal cost profit is given. What was the absorption overhead rate per unit during the accounting period? I told you that was can easily be calculated. Okay. Now, I told you when this type of question comes, very easy. What you do, 284,000 minus 250,000. 34,000, okay? Okay, now, difference of opening and closing inventory, 4,000 units. 34,000 divided by 4,000 units. Answer 8.5, simple. This is the trick to solve this question. Okay. Question 26. Now, the selling price of product event, in which circumstance will the break-even point in unit decreases? Break-even point is decreasing. Increase in labor cost. Increase in total fixed cost. No. Okay. Only decrease in material and decrease in variable cost per unit. 2 and 3 could be the answer. So answer is option B. Getting my point here. Increase cannot decrease the break-even point. Okay. A company makes and sells a single product type. This product is sold for $50 per unit, variable cost $20. Total fixed of 5. How many units of product does the company need to sell to make a profit of $300,000. Okay. First, what we have to do. Okay. Now, fixed cost 500,000 plus profit 300,000, $8,000 total the company needs. 5,000 fixed cost, 300,000 profit divided by $20. So that means 40,000 is the answer. Very simple. Okay. Now come 28. In which order of priority should the okay, sorry. Now, a business makes and sells three different types of products M and O. The following is available: selling price, direct material, direct labor, variable overhead, fixed overhead, profit. Each product uses the same direct material which is in short supply. Okay. In which order of priority should the product be produced to maximize the profit? I've already explained in my previous videos also. Okay, this question is very easy to calculate. Now see, क्या करेंगे हम? Now see, take selling price 240 minus direct material 110 minus 65 minus 20. So yeah, there 45. That 45 is contribution. Now direct material 110 divided by contribution 45%. That would be 244%. Okay. Now what about N? 280 is the selling price minus 120 minus 90 minus 30. So it means 40 is the contribution. Okay. Now direct material 120 divided by 40%, 300%. Okay. Now take out selling price 250 for N. Oh, sorry, O minus 90 minus 100 minus 25. So the contribution in that case is 35. Now direct material 90 divided by 35% is 257. Now see, whose percentage is lower? M. So M will produce first, then O, then N. MON is the production. So B option should be the answer. Getting my point here? Okay. A business has the following information. Okay. Break-even point 5,000 units. Variable cost per unit $27. Contribution to sales ratio is 40%. So what we have to do? 5,000. Break-even point is 5,000 units. Okay. How much? Okay. It's very easy now. See. Contribution to sales ratio is 40% and variable cost is 27. It means variable cost is 60% to the sales. So $27 multiplied by 100 divided by 60. Selling price is $45. $45 multiplied by 5,000 units, that would be 2,25,000 minus total variable cost 1,35,000. So 90,000 is the fixed cost. Why does a business prepare budgets? To assess their non-financial performance. Nothing to do with budgets. Okay. Control their expenditures. This could be the correct answer. This is to strategically plan several years ahead. No. Value the assets and liability. No. So B option is the answer. Okay. So that's all for today. Inshallah, I'll come up with the structured paper of AS. Inshallah, soon. So take care. Allah Hafiz. Happy Independence Day.